AI is forcing me to change how I manage my money. You see, I've made millions from investing over the past 35 years, and most of that success has come from one simple strategy.
An S&P 500 low-cost index fund.
S&P 500 index fund.
The S&P American.
The S&P 500.
The S&P 500
has returned an average of over 10% per year.
This is known as passive investing, as your money automatically gets split between the top 500 companies in the USA. So rather than having to actively pick winning stocks, you instead just buy a small piece of all of them. The idea is that even if some stocks crash, owning lots of them protects you and you still benefit as the overall market grows. I'm not going to lie. Over the years, this has been proven to be a fantastic strategy. As I've said, I've earned millions doing exactly this. However, after making my last video about a potential AI bubble, I sat down, reviewed my investments, and made a few changes.
Okay, so I do get a little nervous when we start talking about how great low-cost index fund investing is, passive investing, which I love. And then the next thing we say is, well, because of something that's a current trend, I'm going to change that strategy. Because, we look at the timeline of, fairly recent history, a lot of things have happened besides AI. And the S&P 500 and these low-cost index funds seem to be doing just fine.
So in this video, I'm going to be revealing the 5 things I changed because of AI. Believe it or not, for every dollar you invest into the S&P 500, 40 cents of it will go into just 10 companies. These companies are Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and finally, JP Morgan. As of filming this video, these companies currently make up a whopping 40% of the entire index fund. What's even more concerning is that Nvidia alone will get between 7 to 8 cents of every dollar you invest into the S&P 500. This is because the index fund is called market cap weighted, which simply means the more valuable a company becomes, the bigger slice of the fund it takes up. So what's actually causing these companies to become more and more valuable? Well, if we put Berkshire Hathaway and JP Morgan to one side for a moment, because they don't really fit the same pattern, something interesting starts to happen. What we're left with is a group of companies that share one very specific trait. They're all spending aggressively on the same thing, AI. You might be thinking, that's great, AI is the future, so this all makes sense. However, not so fast. For all these AI companies to justify their current valuations, they would need to make around $2 trillion in revenue. To put that into perspective, that's more than Nvidia, Microsoft, Apple, Alphabet, Amazon, and Meta combined in 2024. This shows these companies at the top of the S&P 500 aren't being valued based on what they earn today, but on what investors expect them to earn in the future. Now, this isn't a major issue on its own, as it's very common for companies to be valued on their future potential. However, it is quite worrying when it's all linked to one type of technology. These companies are all essentially making the same bet that AI is the future, and they're financing it with a ton of debt. A great example of this is Sam Altman saying he's willing to commit $1.4 trillion in spending for AI infrastructure, when his company, OpenAI, is currently only making $13 to $20 billion in yearly revenue. A lot of this debt is also pretty hidden. As I discussed in my last video, these companies are bumping up their valuations by passing money around to each other. It's a whole complicated mess. Long story short, it's all a massive feedback loop that keeps reinforcing itself. Bigger companies attract more passive investment, which pushes their prices higher, giving them a bigger share of the S&P 500, and therefore even more money to grow from passive index fund investors just like us. This is having a knock-on effect of making the US economy look strong. However, data from Deutsche Bank actually argues that if it wasn't for AI spending right now, then we'd already be in a recession.
Yes, I don't really agree with that last part there. There is no doubt that there's obviously so much money and debt being poured into AI, and whether or not it's a bubble or not, time will tell. But I'm not really going to change my investment patterns, because the reality is with a market capped weighted fund like the S&P 500, if AI isn't, as big as the projections are shown to be, which is beyond my understanding, then other companies will, those companies will shrink in value, and then the other companies that elsewhere putting their resources, those companies will increase in value, and I'll naturally own more of those by investing in those low-cost index funds. That's kind of the beauty and the point of the low-cost index funds, is that you don't need to try and guess, is AI going to be the next big thing? Is it going to be like Web3 or all these other things throughout history? You can name a bunch of different things that it's going to be, because you just kind of own the market in a way, and you are owning the accelerating growth, whatever the next thing is going to be naturally, just because it increases naturally. And if it's not the thing, then it falls out. These are companies with billions and trillions of dollars are working with, so if they are wrong in that sense, then other companies will take their place. That's the beauty of the index funds.
So what if, instead of prioritizing the biggest companies, we could spread our money equally across every company in the S&P 500? Well, we actually can, with something called an equal-weighted S&P 500 index fund. And on the surface, it looks like the perfect solution. Instead of having 40% concentrated in the top 10 stocks, it's around 2%, as every company is treated equally. By investing in something like this, there is no doubt that you're less exposed to the potential AI bubble that's currently forming. However, it's not the perfect solution, because by trying to limit the money going into larger companies, it might actually lead to a much bigger problem, as it follows something called a negative momentum approach, which sounds complicated, but it's really not. All it means is that when a company in the S&P 500 starts to take off, think Tesla during its big run, the fund automatically sells some of it as it rises and uses that money to buy companies that haven't gone up. So you're effectively selling the winners and buying the losers, purely to keep everything balanced.
Yeah, I really am not a huge fan of equal-weighted S&P 500 funds. I mean, that really is basically, you're going to be hurting your growth so much, because the companies that are making the most money, growing the most, and have the most future potential and valuations are going to be the bigger companies in the S&P 500. So if you have them all the same equal weighted, yeah, you are kind of in theory going to be buying those losers and selling the winners a lot of the time too. So instead of trying to guess that, the market cap weighted ones are better at that. The one benefit of this, of course, is it's going to dampen volatility. So if that is a big priority to you, then I guess there is a use case for that. But again, I think there's probably other better ways to achieve that. But yeah, you really are going to be missing out on a ton of long-term growth just to own and dampen the volatility. Really not a solution. It's more of just an alternative, inferior option, really.
On the flip side, a normal S&P 500 index fund that's market cap weighted doesn't need to trade nearly as often. When a company gains momentum, it's simply allowed to take up a bigger share of the index. Instead of trimming the winners, the fund gradually reduces exposure to smaller companies to make room for the larger ones. But why does this matter? Well, the more a fund trades, the higher the costs are. Therefore, it's something that's often overlooked and can eat into your gains. That's why, although I'm putting less money into the S&P 500, I'm still keeping the majority of my stock market portfolio in the regular market cap weighted version. So now I've freed up some of my money from the S&P 500, the real question is, where is it going? Well, that brings me on to... I want you to imagine for a moment that the biggest stock market returns over the next 20 years don't come from the USA. I know that might sound crazy, because for the last 14 years, the American markets have absolutely dominated. However, this chart shows which countries made up the largest share of the world's stock market at different points in history. And guess what? It hasn't always been the USA. I know this looks a bit confusing, but it's effectively showing the global stock market just like a cake with multiple layers. Each color represents a different country, and the thickness of each layer shows the percentage of the world's stock market that country makes up at that point in time. The cake itself doesn't change. It's always the global market. What changes is which layers get thicker and which ones get thinner. Let's look back at 1900. The United Kingdom was the global superpower. As you can see, they had a nice juicy 24% layer of the global stock market cake. London was the financial capital of the world. British companies dominated global trade, and the empire stretched across huge parts of the globe. If you were investing at the time, it would have felt completely obvious that the UK would remain the dominant economic force for the next 100 years. Investing anywhere else would have seemed ridiculous, and yet That's not how history played out. I remember seeing something very similar happen later with Japan. I went to Japan a lot throughout the late 1980s and early 90s. And at the time, Japanese companies were performing incredibly well, particularly in areas like cars, electronics and technology. Meanwhile, the US economy was struggling. Inflation was high, growth was slowing, and a lot of people believed that Japan was the future. So if you were investing back then, would you have bet against Japan and doubled down on America? Probably not. However, America bounced back big time. This show.
So I really love this visualization that he has on screen here. One thing I will say though is, we never really recommend, or a lot of financial advisors never recommend to be 100% in US equities. If we're talking just an equity portfolio, we usually have probably 20-30% in international, anyways, I would do low cost index funds that are internationally exposed to international equities. So I don't think you should be 100% in US stocks. Is it going to be a detrimental thing for a lot of people? No, because it gets you most of the way there. But I think for a more optimized portfolio, I would have most in the US and then definitely have like 20-30% international. Now, in terms of trying to guess and choose which company or which country is going to do in the long term, that's obviously very difficult. But based off his own chart, you can see the US has actually, even though there's been times where it's gone up and down, even since that chart started in 1900, where it was pretty closely tied to the UK, it's been pretty dominant over those 120 plus years or so. So again, Japan, yes, had that big boom and bust. And, the question of Japan, it had a time frame in there when it was very, very small, and then it had this big boom. So I'm not sure if that's a fair comparison to the US, which has had a much greater share of that total market exposure for a much longer period of time. But then again, we can't predict what, exactly is going to happen. Sure, the US, could shrink, but if I was going to, bet over the next 50, 100 years, I would feel more comfortable with betting on the US with international exposure. But again, I still think that there's different funds out there that you can build and portfolios that you can build to sort of diversify and, re-strategize your risk across the different countries out there.
The only thing that's ever been certain in markets is uncertainty. Leadership changes, economic dominance shifts, and no country stays on top forever, which is exactly why I don't want my portfolio to rely entirely on one market, even one as strong as the US. Because when you only invest in the S&P 500, you completely miss out on companies like TSMC, Samsung, Toyota, Tencent, AstraZeneca, and HSBC. These are global businesses operating at huge scale, driving real growth, yet they're excluded purely because of where their headquarters are based.
Yeah, I don't disagree with that in a sense, but then again, that's where that international exposure would come from in a good balanced portfolio. At the same time, though, you could argue that you shouldn't be chasing some of these companies that are out there that maybe just have that survivorship bias and are just doing really well. So if you can try to get the best of both worlds, which is own a lot of the US stock market and then, own some of those big companies out there from the international side too, that's probably a good balanced approach. So far, it doesn't seem like he's really changed a whole lot with his money because of AI. So maybe there's some other changes that are coming here, but it seems like most of it's pretty much the same.
So how am I actually investing globally? Well, this is Trading 212. It's the broker I personally use. And if you go to the search bar and type in VWRP, you'll find this global stock market fund that gives you instant exposure to pretty much the entire world's economy. This single fund invests in around 3,700 to 3,800 companies spread across more than 45 developed and emerging countries, including the US, UK, Europe, Japan, and fast-growing economies like China and India. And yes, I know if you dig into what these funds actually hold, you'll see they're still heavily dominated by US companies. The difference is what happens over time. A global fund automatically rebalances. If the US becomes less dominant and China or another country starts outperforming, the fund adjusts. If the US continues to lead, it adjusts for that too. It also has an extremely low expense ratio of 0.19%. That means for every $1,000 invested, you're paying roughly $1.90 annually in fees, which is pretty.
Yeah, I wouldn't call it extremely low expense ratio because obviously there's ones that are quite a bit lower than that. And I don't know the specific fund, so I obviously can't advise on that or anything like that or share my opinion on it. In terms of international exposure though, if I remember correctly, there's a fund by Vanguard VT. I think that's like the entire world, basically. Every stock in the world is in that one. And then just for international, without the US, I believe VXUS is also a good fund for international exposure. So there's just some different ways to play it out here. I think Mark is either plugging, I don't know if he's plugging the fund, or I would imagine the app that he's using. Personally speaking, I like Schwab, Fidelity, Vanguard, one of those three. They're all pretty good brokers, to work with. There's a lot of these YouTubers that do get sponsored by these companies like, Webull and all these other companies in these brokerage accounts. But truly, I would stick with the big three, in my opinion. But maybe it's a good app, I don't know. But again, I can't speak on this fund specifically, but if you want international exposure, I would look into the funds that I mentioned, because I think their expense ratios are even lower. But again, I haven't checked that in a minute, but something to keep in mind here.
Cheap. If you're based in the USA, then I'd recommend looking into Fidelity's international fund with the ticker FSPSX. The best piece of advice I've ever been given about building real wealth is that you don't get rich by following the crowd. You get rich by being early. I've applied this thinking throughout my whole life, so as well as protecting myself against the potential AI bubble, I also think it's important to look for a way to benefit from this new technology. So let me talk you through where I see the biggest opportunities at the moment. The market naturally breaks down into 4 clear zones.
So real quick here, I just want to say I love a lot of the visualizations that Mark here makes. I will say though that idea of you can get rich by you won't get rich by following the crowd. I don't really think that applies to the stock market. I think the stock market's good when you kind of do follow the crowd when it comes to like low cost index investing. Nowadays that's more popular. I don't know if trying to be early on certain things when it comes to investing is the best approach unless you are trying to do more of a high risk, almost like angel investing. That's a whole different thing, right?
Each one filled with different types of companies. Well, that's how I look at it anyway. Let's start with this one. I call it the crowded zone. Companies in this zone have a large market cap and expensive valuation. Think the top companies in the S&P 500 such as Nvidia, Tesla, and Meta. It's crowded as everyone is already investing here, even passive investors. Under that, we have the defensive zone. This includes companies like McDonald's, Walmart, and Coca-Cola. These are businesses that people rely on no matter what the economy is doing. These are the kinds of companies value investors like Warren Buffett love. Their valuations aren't low, but they're good value because their earnings are predictable, demand is stable, and they keep generating cash year after year. In the top left is the speculative zone. These are smaller companies that are extremely hyped and have valuations that far exceed their current revenue. They usually have low or modest market caps, but very expensive stock prices because investors are betting on massive future returns. Examples include companies like Beyond Meat, Peloton, and AMC during their hype phases. I personally stay away from these kinds of investments as they're highly speculative and driven by momentum and internet hype. If you ask me, it's closer to gambling. That brings us to this one. I call it the overlooked zone. Now this is where I believe there is a ton of opportunity, especially when it comes to AI. Let me explain. The companies in this crowded zone are all betting on the fact that whoever spends the most money developing the absolute best AI model will have all the profits. But what if that isn't the case? A pattern I'm seeing more and more amongst startups, small cap and medium cap companies is they're actually giving the user the ability to pick between different AI models within their software. They let users choose between Claude, ChatGPT and Gemini, just to name a few. This is important because they're now all getting pretty close in abilities, so the biggest factor in what a user chooses might end up being the price, which would then lead these companies into a price war, which is great for people using AI, but not so great for huge companies that have spent billions developing these AI models. It's kind of like petrol or gas if you're American. Imagine one station sells it for $1.50 per litre, and another sells petrol that's slightly better quality for $3 per litre. Sure, a few people will still pay the extra for the premium option, but most people will just buy the cheaper fuel because it pretty much does the same thing. And that's the real point. When new technology becomes good enough and interchangeable, the value doesn't stay with the companies that spent the most money building it. It flows to the companies that use it in the smartest way. So that's exactly why I'm backing the underdogs. Small and mid-cap businesses don't need to win the AI arms race. They just need to apply AI to real problems at a lower cost without carrying billions in debt. That's why I'm investing in a couple of small and mid-cap funds, as well as actively looking for AI startups to invest in. So if you're a founder and you're looking for an experienced investor with a large social media following, then feel free to reach out using the email in the description. I'm currently considering proposals. Look.
Okay, so I was kind of onto something there when it came to like the angel investing. So Mark is obviously, and I'm sure has a very high net worth. He has a big YouTube channel. So for him, pouring more money into a more speculative investment, if it goes well, it's going to be good for him, and he can get more rich easier. But if you're talking to the average Joe, putting money into things that are more speculative and putting money into things that have a higher potential for growth, but also a potential just completely bust, that's dangerous. And when we're comparing, these companies that you didn't really name compared to, say, like NVIDIA, I mean, NVIDIA's got a lot of money and they can crush and buy out competitors very, very easily, which would be good for that company to get bought out. But then again, it's like, why pick and choose? Why play all those games? You can have a balanced portfolio that owns the big companies. It owns international. It has some small caps in there, medium caps, things like that. You don't need to try to pick and choose and try to figure out all these other things. Now, if you want to set aside a portion of your portfolio or your money to do more like angel investing, things like that, and you're risk appropriate for it, that's a different conversation. Clearly, Mark is. But for most people watching this video, I would argue that's not the case, and just sticking with low-cost index funds, and when it comes to the investing side of your finances, is going to get you most of the way there. That's just my opinion, but I think it's right.
If I'm wrong, I lose a small amount being early. But if I'm right, I'm positioned where there could be a massive upside. I feel like a lot of people don't understand that every major leap in technology creates opportunity, but more importantly, instability. I mean, AI isn't just changing companies, it's changing power, currencies, and trust in the system. That's why I'm increasing my gold reserves, and I'm not alone. Check this out. This chart shows China's gold levels between 2009 and 2025. Up to 2023, they were steadily buying gold, but as you can see, in recent years, they've been buying up more gold than ever. But why does this matter for everyday investors like us? Well, many people believe China is trying to replace the US dollar, as they're not just buying it quietly, they're making it usable. They've been building something called the Gold Corridor, which allows gold to be stored across different locations and used as a form of trust in international trade, especially with Brazil, Russia, India, and South Africa, otherwise known as the BRICS nations. And it's not just China. Gold has now overtaken US treasuries as the world's largest foreign reserve asset held by central banks worldwide for the first time since 1996. So why are we seeing this sudden shift towards gold? Well, as of 2025, gold has been reclassified as a Basel III Tier 1 asset.
I believe that actually is incorrect. Even their own website, I believe, has corrected that because there's some more technicality to it than that. So just want to put that out there. I mean, personally, I don't really care that much when it comes to that stuff, but just for somebody who's a bit of a gold investor, it's just something to consider.
Put simply, gold can now be treated the same as cash or US treasuries on a bank's balance sheet, which is a big change because before this reclassification, banks weren't allowed to count its full value. This is having a big effect on the price of gold because before this change, most financial institutions like central banks, sovereign wealth funds, and pension funds kept around 20% of their reserves in gold and equivalent hard assets. However, the Bank of America have now published new guidelines saying the gold reserve should be closer to 30%. That 10% increase is driving up demand because you can't print more gold. Some people are even saying in 5 years, gold could be worth double what it is today. And I don't think that's absolutely unreasonable.
So yeah, gold's a very interesting thing, right? So gold prices have been increasing a ton recently. And the question is, do you think it's going to keep increasing? And if you should, put a portion of your portfolio in there? People have asked me that. I usually say you can put in like 1 to 5% if you really want to, or 0%, just because long term, especially with inflation considered, gold has done actually pretty poorly. I think its real return over the very long term is like 1%. So again, it's just, I don't think, for me and for a lot of investors, I'd rather be exposed to good quality, equities. I don't want to be invested in gold. And while it is true that, you can't print more gold, you also, there's a lot of things you also can't do with gold either. It doesn't give you a dividend. It's literally a metal. And so when you consider that, and again, I'm not like some gold hater. I own some gold. I think gold is really fun to collect. So I'm not a gold hater at all. Same thing with silver too. And sure, the price could keep going up, could go up to 10,000. I'm not willing to make that bet, but if some people are wanting to diversify or add in a little extra something else, I get it. But for me personally, for a lot of our clients, we aren't investing in gold. And there's always going to be a million reasons to invest in gold, but especially with its recent run up, you might be buying kind of the chase, in the top on that. So I think I'd rather stick with what's shown to work well and likely will continue to work well. But then again, there's a lot of factors that go into that too.
I won't go much deeper into gold in this video, but if you want me to break it down in more detail in a future one, just give this video a thumbs up and let me know. If we get, let's say, 150,000 likes, then I'll make one right away. For now, let's skip to the part I know a lot of you care about. How do you actually invest in gold? I personally do it a couple of different ways. Firstly, I buy physical gold. This is my long-term insurance, and as I'm old school, I like having something I can actually hold. Secondly, I dollar cost average into this iShares physical gold ETF on Trading 212. I like doing this because it gives me a lot more flexibility to gradually buy in and move things around when I need to. So to be clear, I'm not trying to buy at the best possible time, and I'm also not going all in on gold. I'm simply allocating a small strategic portion of my portfolio to gold, the same way countries and major financial institutions are doing. The biggest mistake young people make when investing is not having a big enough cash reserve in case something happens in their life, which often forces them to sell their investments at the worst possible time. Even as an older guy, this is still something I have to consider, especially if we're in an AI bubble. And you might be interested to know that Warren Buffett, the most successful investor of all time, is currently increasing his cash pile. Check this out. As you can see, he's been aggressively increasing his cash pile over the last couple of years, and as of Q1 2025, he has a whopping 347.7 billion in cash and cash equivalents. This makes sense as he's a value investor and only buys when the price makes sense, and right now, he simply doesn't see many opportunities that justify putting that cash to work. That's why I'm going to be holding slightly more cash, because if the markets crash, I don't want it to negatively affect my life.
So that's a little dangerous. So I would argue, I've seen so many articles in the last 5, 10, 15 years of Warren Buffett's cash reserves growing and growing and growing, which they're going to naturally just due to inflation and other factors. But the reality is, I don't think you should try to time the market and increase your cash reserves just because we think that valuations are high. And, I thought 10 years ago, probably 7, 8, 9 years ago, I thought NVIDIA was crazy high valued. It's crazy, all these articles, it's gonna bust. Look at it now, it's even crazier. So I just don't think that as an individual investor, we should be trying to raise our cash reserves, trying to wait for the market to crash, because that's likely to be detrimental to long-term portfolio performance, just for the fact that you are gonna be missing out on gains because you're increasing your cash reserves in the short term. And then you kind of gotta sit there and wait and wait and wait, while the next guy is just gonna keep buying and buying and buying. So if prices do come down, which they certainly could, if prices do come down, you should be buying and buying and buying. That likely is going to do better than waiting and trying to guess when the market's going to come down and buying in a bigger batch. Now, I don't think it's entirely unreasonable to have some amount of cash, because you do want to have enough cash to buy in if the market does go down, but raising it considerably or making it like an emphasis of changing your portfolio to do that, I think that is detrimental to your portfolio.
A bit more cash on hand also gives you the opportunity to buy more investments when the market crashes. And I say when, not if, because it always happens at some point. I was also focused on improving my money-making skills during the dot-com crash in the early 2000s. And that came in super handy, as I was able to generate fast money that I could then invest into the stock market.
Cash is very nice, but again, it might be a plug for the course of the event. but I would not be, waiting around for the stock market to come down and raising cash. But yeah, I mean, you should always be finding ways to increase your income and, growing your net worth. So it's a bit of a plug for a course and an event, but in reality, I would not be chasing that next downturn because it's going to happen. But the part he's kind of leaving out is that you don't want to try to guess when it's going to happen. That's going to hurt you really bad.
I've seen way too many people wait years for a market drop and miss out on massive gains in the process. That's why my strategy is simple. I'm still going to keep putting most of my money into the S&P 500 so that if AI continues driving growth, I'm invested in the businesses leading that change. But to protect myself from a potential AI bubble, I'm also diversifying into the global markets, small and mid-cap stocks, gold and cash. Because the truth is, nobody knows what the market will do next. So instead of trying to predict it, I'm preparing for both outcomes. If you want to learn exactly how to invest for beginners step by step, then I'm going to leave that video.
Yeah, so he's made some changes there. Again, a lot of this is also going to come down to what are your goals? What are your investment timeline, your risk capacity, your risk tolerance? These are really big things that you have to consider before trying to make changes to your portfolio. For most people watching this video though, I really do believe those low-cost index funds, so things like VTI, which is a total US stock market index fund, it owns every stock in the US, or just a low-cost S&P 500 index fund like VU, and then some international exposure in there as well, like the ones I mentioned earlier. I think if you're on the higher risk spectrum, so you can be 90, 100% in equity or stocks, that's going to get you, most of the way there, if not all the way there. Obviously, if you're like say in retirement, that's a different conversation, because if you should be 100% in stocks in retirement, that's a different conversation. That's going to depend on your net worth, your risk capacity, your risk tolerance, your timelines, your withdrawal strategy, taxes, so many different things. Because a lot of retirees aren't going to stomach 100% equities in reality. So again, I would just be very careful when you watch these videos, because there are a lot of times people are just saying things to either come up with content or plug something. And I think Mark makes very good videos. It's just, be very careful about changing your investment strategy when other people are recommending or showing you what they're doing, because you don't have the same risk tolerance capacity that Mark does likely. So you really got to consider these things. But again, that's really all I have to say. If you have any questions, let me know in the comments below. I know this is a pretty long video, but I think this is important to cover because so many people are worried about the AI bubble. But I think that, what we have set up already is already gonna figure things out on its own, and you don't need to worry too much about it. So again, thank you guys so much for watching, and I'll catch you in the next video. Take care.